Hey everyone, and welcome to a brand new explainer right here on the Gap Advisors Ind AS Clinic YouTube channel. I'm absolutely thrilled to have you here today. Now, before we jump right into today's breakdown, let's just quickly set our standard ground rules. For the context of our discussion today, our functional and presentation currency is the Indian rupee. So any currency other than the Indian rupee is considered a foreign currency. Also, our reporting period begins on the 1st of April and ends on the 31st of March. And of course, I have to mention the standard disclaimer: the views expressed here are purely the personal views of the author and aren't legally binding on the audience. We always request that you seek out the help of an expert before taking any action or refraining from any action based on what we discuss in this explainer. All right? Let's get into it.
So right off the bat, I've got a bit of a challenge for you. Do you think you can spot the other comprehensive income, or OCI, error hiding in a published cash flow statement? Today, we are conducting a real investigative review of a published Ind AS financial statement from a listed company. This was actually downloaded and independently reviewed by Gap Advisors on a suo motu basis. And look, if you happen to invest in listed company shares, reviewing a company's financial statements for Ind AS compliance can genuinely help you make proper decisions on buying, holding, or selling those shares. It is fascinating how catching just one nuance can completely shift your view of a company's financial health. By the way, this specific observation we are dissecting today was actually featured in the 216th edition of the Gap Advisors Task Weekly newsletter. This is a truly fantastic resource authored by CA Manish C. Iyer, director at Gap Advisors, and it's published directly on LinkedIn. To date, there are over 230 editions out there. If you are on LinkedIn, I highly recommend you subscribe to the newsletter for free. It's an absolute goldmine. Oh, and a quick side note. While our response today is framed under the Ind AS framework, there's literally no difference between Ind AS and IFRS for this specific topic. So if you're an entity following the IFRS framework, stick around, because this discussion applies 100% to you as well.
Okay, let's kick things off with Part 1, the rulebook, our Ind AS 7 baseline.
Let's look at exactly what the standard actually says. Paragraph 20 of Ind AS 7 explains the indirect method quite clearly. It states, under the indirect method, the net cash flow from operating activities is determined by adjusting profit or loss. Stop right there. I want you to mentally highlight that phrase, adjusting profit or loss. That right there is the starting line. Everything we do in the indirect method has to stem from that initial figure.
The standard then goes on to explain what exactly we are adjusting that profit or loss for. It gives us three main buckets. First, changes during the period in inventories and operating receivables and payables, so essentially working capital changes. Second, non-cash items. Think depreciation, provisions, deferred taxes, unrealized foreign currency gains and losses, you get the idea. And third, all other items for which the cash effects are investing or financing cash flows. This just brilliantly illustrates the core mechanics of the indirect method, right? We are just stripping away all the non-cash and non-operating fluff to get to the true actual cash generated by day-to-day operations.
All right, let's move right along to Part 2, the evidence, examining real financials. Okay, take a look at this. We are looking at the cash flows from operating activities using the indirect method. Right at the top, the starting point is net profit after tax, reported at $134,445.44 for the year ended March 31, 2020. Now just scan your eyes down that list of adjustments. Do you see the highlighted item near the bottom? Remeasurement of Defined Benefit Plans. And it's showing a negative adjustment of $4,414.00. Keep that in your head.
Which brings us right into Part 3, the disconnect, mixing separate buckets.
See, there is a fundamental disconnect happening here, a major mechanical flaw in the company's reporting logic. It essentially comes down to profit after tax, or PAT, versus other comprehensive income, or OCI. Remeasurement of defined benefit plans is an item that is strictly mandated to be reported in OCI, and because it's reported there, it is completely excluded from profit after tax. They are just two entirely separate destinations on the statement of comprehensive income. So let's look at the evidence one more time. Remember, the company started with net profit after tax, but we just established that the remeasurement of defined benefit plans was never even included in that starting figure to begin with. So mathematically and procedurally, how can you possibly adjust a starting figure for an item that isn't inside it? It's literally like trying to remove an apple out of a basket that only contains oranges. It makes zero sense. Accordingly, profit after tax simply must not be adjusted for items reported in other comprehensive income.
And that brings us to our final verdict. Number 1,
Remeasurement of defined benefit plans is an OCI item. Number 2, profit after tax does not include OCI items. Number 3, because the company adjusted profit after tax for the remeasurement of defined benefit plans reported in OCI, it's perceived that the company has not complied with the strict requirements of Ind AS 7. It is a massive foundational error in the mechanics of their cash flow statement.
Now, spotting these exact kinds of nuances is literally what we do. If you want to dive deeper into issues just like this, head over to gapadvisors.com. The issue repository there hosts over 4,500 issues and their responses on Indian accounting standards and Indian GAAP. Anyone can register for free and submit issues for a detailed response delivered directly to your inbox. This is incredibly useful for auditors who need to rigorously document how they addressed any issue relating to the application of Ind AS. Also, please, get your financial statements reviewed by GAAP advisors before signing them. You can submit your financial statements in a near-to-publishing PDF format via email to info@gapadvisors.com. And hey, if you have specific, complex issues, you can even book a one-on-one consultation regarding Ind AS and IFRS directly with the author from his page on topmate.io.
I want to leave you with a provocative question to chew on as you check your own work. Are your indirect cash flow adjustments strictly sticking to profit and loss? Or is OCI bleeding in where it absolutely doesn't belong? Thank you so much for your time today. If you got something out of this explainer, please hit that like button, add your thoughts in the comments, and make sure you subscribe to the GAAP Advisors Ind AS Clinic channel if you aren't already. I also strongly request you to share this explainer among your contacts, your colleagues, audit and finance teams, and especially among students pursuing their CA course to help spread the knowledge of Indian accounting standards. Finally, be sure to connect to the GAAP Advisors Ind AS Clinic podcast over on Spotify, Amazon, or YouTube for a much deeper dive into the observation we dealt with today. Until next time, keep your fundamentals strong and your cash flows clean.